The mortgage that looks cheaper up front is not always the one that actually costs less. A lot of veterans hear VA funding fee and immediately assume the conventional loan must be the better deal. Once you compare the real cost structure, including down payment, monthly payment, PMI, cash to close, and how long the vet plans to keep the home, the answer can look very different. I'm Cathy Sabater, mortgage strategist and proud veteran, and in this video, I'm breaking down the real cost differences between VA and conventional, not just what you pay at closing, but how the math actually works over time. The biggest mistake veterans make is comparing one fee instead of comparing the full structure of the loan, because VA and conventional are built differently. With a VA loan, eligible borrowers may be able to buy with zero down and no monthly mortgage insurance. With a conventional loan, buyers may have to put down less than 20%, but if they do, they usually pay monthly PMI, premium mortgage insurance. That difference matters. Now, let's start with the VA side. Yes, many VA purchase loans include a one-time funding fee. For many purchase loans, if the veteran puts down less than 5%, the current funding fee is typically 2.15% for the first use, 3.3% for the second use, or the third use, or the fourth use. If the vet puts 5% down, that fee usually drops down to 1.5%. And if the veteran puts 10% down, it usually drops again to about 1.25%. So why would a veteran ever put money down on a loan that allows zero down? Well, sometimes it's to reduce the funding fee. Sometimes it's for another practical reason. They need to bring money down to reach the purchase price that they want, or to keep the payment where they want it. Maybe the approval amount is not close enough, so maybe the borrower wants a stronger monthly payment position. Maybe they want the house, but they do not want to stretch too far to get it. That is why many smart VA buyers do not just ask, "Can I buy with zero down?" They ask, "What gives me the strongest overall strategy?" Now, here's the part many veterans misunderstand. You do not have to pay the VA funding fee in cash at closing. In many cases, and in most cases, it is financed into the loan amount. That means it increases your loan balance, but it does not always mean a bigger check at closing. Some veterans do not pay the funding fee at all. That can include certain veterans receiving qualifying VA disability compensation, some Purple Heart recipients on active duty, and some eligible surviving spouses. That exemption matters because once the funding fee is removed, the VA loan can become even more powerful. Now, let's look at the conventional side. A conventional loan does not have a VA funding fee. That sounds attractive at first. If the military home buyer puts down less than 20%, they usually pay monthly PMI. And PMI is important to understand because it does not build equity. It does not reduce principal. It's simply an added monthly cost for putting less than 20% down. That is where a lot of buyers get the math wrong. They see the VA funding fee and think, VA must cost more. They look at the PMI and think, that's not a big deal. Sometimes it is a very big deal. A one-time fee versus a monthly recurring charge are not the same thing. So the real math is this. Does the one-time VA funding fee cost more, over time than the monthly PMI, premium mortgage insurance, on a conventional loan. Sometimes yes, sometimes no. A lot of the time, especially for VA buyers using little to no down payment, the VA loan compares very well. Why? With a VA loan, there may be a funding fee, but there is no mortgage insurance. With a conventional loan, there may not be a funding fee, but now the buyer may have to carry that monthly PMI, that's the premium mortgage insurance, until they have enough equity that is built. That monthly cost can add up fast. Now, this is not to say about using VA always wins. It doesn't. There are situations where conventional loan may be a better fit. For example, if the service member has a larger down payment, if the VA buyer has excellent credit, if the buyer does not want to finance a funding fee, or if a specific property or strategy makes the conventional loan the cleaner option. So this is not about the loan being automatically better. It is about the comparison of two buyers that hear funding fee and stop. The analysis right there. That is not enough. You have to compare the down payment, the monthly payment, and whether PMI, that premium mortgage insurance, applies, whether the funding fee applies, whether the fee can be financed, whether the borrower may be exempt, and how long the veteran family expects to keep the home or the loan. That is what determines which option actually costs less. That is why cash to close matters too. A buyer may assume conventional is easier because there is no VA funding fee. That does not automatically mean lower cash is needed at closing. Cash to close is affected by much more than just one fee. Closing costs, title and escrow fees, prepaid taxes, insurance, earnest money deposit, inspections. So once again, a buyer who compares only one fee is not seeing the full picture. A better question is not which loan sounds cheaper. It is which loan actually gives me the better structure for my money, payment, and my long-term plan. So let's simply give you the bigger takeaway. A VA loan may have a one-time funding fee, but often has no mortgage insurance. A conventional loan may avoid the funding fee, but may come with the monthly PMI. If the down payment is, of course, less than 20%. So if you're comparing the two, do not compare just one line item. Compare the whole cost structure. The cheaper loan on paper is not always the cheaper loan in real life. Sometimes the loan that looks more expensive upfront may actually be the better long-term financial move. So a VA does not automatically make the VA loan more expensive. But if you're buying new construction, the game changes because now you're dealing with builder incentives, preferred lenders, and renegotiation strategies, not just loan math. So next, let's break down how to use a VA loan for new construction the smart way.